So thank you, Evan, and welcome. And for those of you who don't know who Evan is, you've obviously been living under a rock for the last few years. Evan is part of NMG Consulting, and he's the partner responsible for the UK and South Africa strategy and consulting operations. He spends his time between these two markets, and he has a background in actuarial science, but trust me, he's not one of those actuaries who are a bit strange. And he's focused very much on insurance and investments, especially the distribution dynamics. And today, this morning, we're going to be talking about what trends he's picked up in the South African market, how do they relate to the UK market, and what are successful and really growing advisors doing for their business to really get them ahead of the pack. So really this morning, Evan's joining me to talk about where we've come from, where we are, and where we're going as an industry. And finally, I'm so sorry if you joined and expected to see Mike Somerton. Unfortunately, he's not available as originally advertised. So you have me instead. And for those of you who join me on Tuesday for our Elevate webinar, I'm sorry you get me twice in a week, but I hope you can bear it for the next hour and a half. And if you don't know who I am, my name's Georgina Smith. I look after the Standard Bank Group's investment products and solutions within our distribution teams. And just a quick note on CPD, we've applied for CPD accreditation, and this will be awarded automatically following the webinar today. For those of you watching the recording, there will be questions following the webinar, which will enable you to claim your CPD. As always, we're very happy to take questions via the Q&A section at the bottom of the screen, and we will do our very best together to answer them, either during the session or at the end of the session. So Evan, great to see you. Thanks so much for joining me.
No, thanks for having me. And I always enjoy when we can have a discussion like this. Thanks for having me.
Fantastic. So Evan, perhaps before we start off, tell us and the audience a little bit about how you go about finding these trends. What do you do year in, year out? Who do you talk to? What's the structure of how you actually derive these trends? Because it's not just anecdotal, is it? It's a very thorough process, and perhaps you can just talk us through it.
Yeah. No. I think it's a key one, because as soon as we start getting into any of my observations and that, I think people naturally look and say, well, has he even advised clients before or anything? And the truth is no, right? So what I'm actually feeding back is observations over the work that we've done in other markets, and I'm largely feeding back advisors' views. Some might be on the call back, but we're doing so at very large scale. So I think, George, if I just look at what we do in the UK and South Africa, obviously we'll consult to whether it's platforms, managers, DFMs, insurers, and that. But a core of the work we do, and the reason I mentioned we do a lot around distribution, is that we interview in the UK probably about 1,000 advice firms in one-to-one discussions every year, 60 to 90 minutes. In South Africa, it's closer to, say, 400. But so what we're doing is, each year, we've got about 400 discussions, one-to-one, with an advisor, an advice firm, and we ask them all kinds of questions around kind of the landscape they're operating in, how they're thinking about their business, how they select an insurer or a platform or a manager or a DFM they work with, how they think those guys are doing, and how they could improve, and these kinds of things. So fundamentally what I'm doing, if you're asking me a question, is I'm going to play back what I'm seeing advisors tell us. And if I say, there's a spectrum, it's kind of, we're seeing some advisors do that and some do that. So it really is kind of me feeding that back mostly.
Absolutely. And you've been doing this for how long, Evan, in the South African market?
Since 2013.
Okay, so
over a decade.
Really is, yeah, it's a really, really comprehensive data set that you're working with, and really very valuable in terms of seeing where this industry has come from and of course where it's going. Now, back when we first met, which is nearly 10 years ago now, Evan, can you believe it? I remember you said to me, what would you like to know? What would you like me to ask advisors for you? And the question I asked you to ask, and I think it's stayed in the pack ever since, is what is keeping advisors up at night? And I think, it really talks to, the things that advisors are fearing, and they're taking a lot of time thinking about them. And I know you've asked that recently. What was the answer? What did people come up with?
All right. Well, yeah, so that's been great. Since you added it, we've watched it go through different phases. And so I think until about 2 years ago, it was dominated by local politics, right? Worried about, whether it's corruption or, political landscape in the markets in South Africa as a result of that. So that's probably until about 2 years ago. 2 years ago, we had a particularly bad time where load shedding was the biggest concern, right? And I hope we never see that one back up there again. But since then, what's interesting is last year and this year, we've seen regulation. It's number one, by far the biggest one. And I think what's interesting was regulation was everyone else in the value chain was telling us this is going to be a problem for advisors. But then the advisors themselves were more concerned with, let's say, load shedding, right? But now, or local politics. But now we've got regulation as the dominant kind of word that's coming through. It'll depend on where that advisor sits, because if it's a one-person business that doesn't have support, like it is the one word they're saying. And then just interestingly, the other point, because I talk about local politics, we now, you can either see this as a positive or a negative for the rest of the world, is we're now in a phase where advisors are much more worried about what's going on in the US than what's going on in South Africa. So global politics is actually the second most dominant one behind regulation.
Wow, and I can imagine America has probably come up a few times in there. It has it. Is what are people saying about that?
Well, it's so I mean, there's one quote where we don't put a name next to it, but they say unpredictable politicians, right? And so I think you can sometimes get there. And I think some of that is around just how difficult it is to predict what's going to take place. So, whether it's tariffs one day or not the next day, etc. And look, I think it is an interesting one because we see the same. We do some work in Latin America as well. And you'll see advisors will say, look, we don't really like all this instability, but it definitely gives us business because then clients come and ask. And as soon as things start getting volatile, we find clients are a little bit less likely to try and do it by themselves and more likely to bring in an advisor. But generally, the advisors we're talking to don't like the unpredictability of kind of the markets, let's say.
Yeah, I can understand that. Now, tell me, going back to the regulation as being the key thing. Obviously, over the last few years, we've had uh, T-Day, Two-Pot, Kofi coming along, and it seems to be coming thick and fast. Whereas, actually for many years we were just talking about RDR, and now it's kind of like coming through thick and fast. Um, is that being borne out in the UK as well? Are they also, I know it's different regulation over there. They've got
Mm.
different things like MiFID and MiFID 1 and 2 coming through and all sorts of other things that they've got over there. But are they also as concerned about regulation? And is this a global trend that we're seeing where regulators are just picking up the pace in terms of actually sending regulations down the pipe?
Yeah, definitely. Actually, the UK is our best case study for what might play out in SA, because sometimes I think this market is a good case study, and sometimes I think it's not, right? And I think it takes you have to be discerning around which ones will follow. And I think the UK is actually perfect for this because sure, there was RDR, and a few things played out in certain ways there, and I've just seen it here in a lot of ways already preemptively. But the most recent one's consumer duty that has had the biggest impact on the advisors we're speaking to, especially in this part of the market. And so advisors told us, they estimate 8 hours extra per client per year as a result of consumer duty.
Oof.
We think it's a little bit less than that, but we do think it's extra hours. Like there's no doubt there's extra hours. I don't have slides, but it's something around a third of advisors in the UK told us in the last 12 months I've had to reduce my client count as a result. It's something around a quarter of them saying I'm going to have to further reduce my client count as a result. And we've gone from 9% of advisors in the UK saying they want to join a larger firm or exit the industry. We lumped them together like sell or join a large firm. Well, it's gone from 9 to 19% in, I think, either 1 or 2 years. So very rapidly. And so, I mean, just on that point, in RDL, we saw the same thing was that a lot of advisors, you'll know 60, 65, 70, and you say, well, they're thinking maybe I'm going to retire at some point, but it's not necessarily right now. But what we did see, for example, in the UK with RDR was when this came through and sunset clause came through with RDR, a bunch of advisors said, you know what, this is when I'm going to retire because it's becoming a hassle.
Wow. Yeah, and of course, consumer duty, and also you hear within that piece of legislation a lot about vulnerable clients as well, which
Yeah.
I also can see coming our way as
Mm.
well. Okay, let's have a think about, before we kind of move on to, okay, well, what impact is that having on movement of advisors in this market? Let's have a look at, one of the uh, things you pick up in terms of those successful advisors. So if you like, are they clear on their value add? What is it they're doing that is really making a difference to their clients?
Mm. Yeah. So I think there's a couple bits in there is that there's what's the value proposition, what's the elevator pitch, and I think we'll get probably I'm assuming we're going to end up touching on a relevant topic around this later, but we find a lot of advice businesses are really driven entrepreneurs, smart, good at what they do, and then the question is now, can they convey that what they do? Can they convey it also to someone else that's coming into the business, right? If they're looking to scale, reach the next level, often there's that challenge around there is value in what an advisor is doing, but then their ability to articulate that, but also, sometimes to themselves. And I think that that's where you see, I got asked the other day where there was this price war around advice. And I said, well, if you're in a price war around your advice fee, you haven't had the value conversation, because you find if you're having the right conversations and articulating the value proposition, then the price is very much secondary. Whereas by the time you're in this kind of, I'll do 50 bips if they do 55, then you're really not on that value conversation. And I think the one observation that we've seen, and something I'll probably kind of refer back to, is that the advisors that are confident around their value proposition have figured out what is core and what is a distraction. And I can say in the kind of hundreds of interviews we see is that some advisors are really clear on this is where I add my value and this is a distraction. And then others we see are doubling down on some of those things that are potential distractions, and it kind of comes at the cost of the value proposition or just comes at the cost of the number of clients they can serve.
Can you give me an idea as to what those distractions might be?
All right. Well, I mean, it's a big topic, so I'm sure we'll come back to it. But one-person advice firms that tell us, I'm going to go and buy up other one-person advice firms. And I was like, okay, great. So in theory, by the way, when you ask advisors in the UK and in South Africa, and you say, who do you want to sell to? Overwhelmingly, they say, I want to sell to someone just like me. But I think what they're not anticipating is, firstly, the people that look just like them have all the same problems. But also the other piece around it is that they may look just like you, but the chances of you having the exact same philosophies and same investment process are pretty low. But also it ends up being very messy. So sure, okay, you can go and acquire, but the reason I categorize that as more of a distraction is when we ask advisors, where do your clients come from? And assuming you're not, starting out, if you've got an established book, the advisors tell us 76% of their clients come from referrals from their existing clients. And if we ask them, have you ever tried to optimize this or ask for referrals? 95%. Now that number's not true. I'm just kind of guesstimating, but almost all of them say, no, I haven't done that. Right. So that's what I mean. Our core would be build a good referral model from your existing base, ask about share wallet, do they have money elsewhere you could bring in scope, etc. Like there's core. And then the distraction is go and try and buy someone where you're going to end up losing half of it, have a fight along the way and everything. So yeah, that's kind of an example. But there's a lot of others, I think, around core and distraction.
Yeah, it's very interesting. I think you make a really interesting point about, the skills it takes to start a business, those really energetic, entrepreneurial, real kind of sticking skills that entrepreneurs have to start and build a business are very different from the ones you need later on as the business matures and then moves through. And I've also observed many situations where a principal says, I want to bring someone through, and they look for someone just like them. But actually, what their business needs at that point is someone who's not like them at all. And therein lies the rub. Because, understandably, principals tend to be quite energetic and vivacious and outgoing characters. So I can imagine how.
I think because we get all. Oh, sorry. I was going to say, yeah, we can all think of an advice firm where there's one of those, like really driven, we won't name names on here, but imagine there's two, right? I'm just trying to think how exhausting, you could have 10, 20 advisors, but often there's one very driven, like unique individual in there. But I'm just trying to imagine how impossible it would be to have two of them, right? Sometimes. So it is, it's hard to match these together.
And tell me, what often happens in these kind of situations is the brand of the advice firm hinges on that one person.
Hmm.
And are we seeing a realization of that? Are we seeing people thinking, okay, well, I can't have the brand hinge to me because, of course, then the value of my business isn't as big as it potentially could be? Are we seeing people try to dilute their influence and really try to build the brand of the business as opposed to the brand of the person?
Yeah. So I think, probably break it into three phases. I don't know if that's just a consulting thing, but I think if we take a one-person IFA now, so we just say, starting out with low confidence and starting out, we find they position behind the brand of the product providers they use. So I won't name names, but if it's a famous asset manager or a platform or something, they'll kind of position behind that and say, oh, this insurer that I'm using, right? And they'll position behind that. Then as they start to gain confidence as their own advice firm, it'll become them as you say, like the key person is the brand and it's intertwined. But then often I think we start to see is there's this opportunity where as it scales, as a business scales up, or if we're just thinking in terms of, a large bank advice force or a large advice network or anything like that, then you get to the point where the brand goes beyond a person and it has its own pool, right? And then there's a chance, because it doesn't matter how good that advisor is, when they're in that kind of middle phase, there's no chance if you poll people on the street that they know the firm or they know that advisor, right? So it is interesting is that next phase. And look, some businesses, it's just unrealistic that they would ever get there because if you're 10, 15 advisors, it's hard to get to that kind of household name. But I think you could kind of see that phase where there's a point at which this is actually a household name or a well-known business on advice. And yeah.
Absolutely. Tell me, coming back to those distractions, those ideas around distractions, what we often see is advisors moving into different parts of the value chain as well. So you talk about acquisition. I think that's you're very, I see that a lot. That's one distraction. What about advisors moving into other parts of the value chain? Is it warranted or is it a distraction?
So I'll start by saying with a lot of the stuff I should have caveated up front. So one, I'm going to err on the side of being a little bit more controversial or and the other one is just to say, at the end of the day, as long as an advisor is compliant, do whatever the hell you want to do because if it's your client base and you're compliant, all of that, right? But I will just observe what feels like the trend now, having looked at this. And for starters, don't have the exact figures in front of me, but the advice fee charged by advisors in South Africa is something like 15 bips lower than the fees charged in the UK. The value chain is lower in the UK. So in South Africa, an advisor is barely taking a quarter of revenue in the chain. The most powerful part of the value chain, right? You own the customer relationship, but you're taking a quarter, right? And you're giving more to managers, more to others. So that's strange. And in the UK, it's over 40% of it goes to the advisor. So before we talk about the rest of the value chain, I just want to observe that right now in South Africa, advisors are definitely undercharging what they could be versus peer markets. And that's 15 bips less in a smaller value chain in the UK, right? So I think that's the first one is that the core or the organic side is that your fee already, there's a lot of evidence that there's runway around it, as long as you can demonstrate and kind of deliver value against that. But then, yes, so then we do see, in that context, we do see some advisors who will participate. The most common one is Cat 2 and sharing fees with the DFM. Right. And again, I think it does depend. So sometimes we see an advice firm grow to the point that 30 advisors, 40 advisors, they build an internal investment committee and say, okay, great. If you want to participate, you can probably defend that post, regulatory developments. When it's a couple advisors that reach a couple billion assets and then they're getting 10 bits from their DFM, we look at that and say, that might be harder to defend. And if we were that advisor, would say, negotiate down those 10 bips away from your DFM, get it 10 bips cheaper, increase your advice fee by 10 bips. That's going to be a lot easier. And so we saw that in the UK, where we've seen this boomerang now, where a lot of mid-sized, very successful firms, but not that many advisors, were starting to participate and get this kind of equivalent of a Cat 2 DFM relationship. And now they're handing it all back to the DFMs. And it's only the really large scale ones that are wanting to really be in Cat 2. And so the final one, where I won't name names, but this is not very common, but we did even see one where a platform said, if you use our platform and you use enough of our funds, we'll pay you through dividends. And we had advisors talking about doing that. And we said, that is going to be really hard to defend. So I guess what I'm getting at is the core and distraction. The core is you're undercharging for
I
your
wanted to
advice
say that
fee.
wasn't innate. Okay, that
No,
wasn't
it
innate.
was, no, it was not innate. It was not innate. But it's just funny is you're undercharging versus global standards for your advice fee. And instead of, it is not the easiest discussion to talk to a client, but now's a good time when markets are up as much as they are, right? So do it now. But you could be charging 15 bips more in your advice fee, a lot easier to defend than saying you're part of a platform or you're an asset or you're a DFM. So anyway, I guess that's one of the examples then.
So what I'm hearing you say is, potentially compared with their peers globally, advisors here are undercharging for their services. Is it because they're not clear on their value proposition? And then, are they actually leveraging the other people in the value chain as much as they possibly could? And that brings me on to my next question, actually. So, talking about DFMs, talking about other people in the value chain. DFMs has been a big part of your survey for some time now. And I'm guessing over the years, well, I know over the years, you've seen more and more participation in DFMs. I'm also picking up more and more advisors who are building their own funds. And I wanted to really understand is that a trend? Is it a distraction? What's the penetration we have in the market in someone's book, perhaps on average, of DFMs? Is there a lot further to go, or is that market saturated? There's lots there to
Yep. There's a few
unpack.
in there. So if we start with, well, actually, I'll start by calling DFM a few different things. So I'll say
Yeah.
using a DFM includes if they've built a fund for your firm, right? Because most of the time, if a firm has gone and built themselves funds, the DFM's involved, right? It might be more,
Yeah.
firm does more, the DFM does more, whatever, right? But I'll count all of that. So as well as using model portfolios. And so I think, so firstly, penetration. So the percentage of advisors we talk to that use a DFM. Firstly, if you're in a large scale advice firm, it's 100%. There's very few exceptions where they don't use any DFMs. Now, some large scale advice firms allow you to use multiple, and some will say this is their house view, right? But there's that. At the high end advisors, we call them holistic advisors, but it's the kind of 750 million of assets and up per advisor is very much high net worth client base. It's quite sophisticated offerings, all this stuff. Those guys, it's over 70% of them, when we interview them, will say I have a DFM partner. And then as you get to, let's say, 200 million to 750, or let's say 250 to 750 million, we'll keep it nice and round, more than half. But what is interesting is in the advisors who are maybe more generalists, they do life insurance as well as investments and a range of different offerings, but they're not yet built up this massive book. They've been largely neglected by the DFM. It's not that they don't want a DFM. It's just that when we go and we talk to the DFMs, they mostly don't have the appetite or desire to extend the kind of target market. So basically what I'm getting at is there's a few thousand advisors that are in, let's call it 100, couple hundred million assets that do not have DFM access, might be 10% there. And so in terms of penetration, it's very clearly based on segments. Generally, it's just over half of the assets have moved when there is a relationship. And of course, that spreads. And I do think, I mean, final point on that is just what is interesting, and I think the next wave we're going to see a DFM is in the UK, we talk about DFM, we talk about MPS. And it's largely what we would think of DFM in South Africa, but the MPS side is efficient, tech-led, more streamlined solutions that are a little bit more accessible and less hands-on. But that way, if we bring it to
MPSP, model portfolio solutions, yeah?
Yes, sorry, yes, you're right. Yep. So, and that we haven't yet seen in South Africa, but I think it's quite an exciting idea because a lot of the very hands-on big DFMs here don't have the capacity to go and talk to any advisors with less than $1 billion or $2 billion, right? And so I think that's going to be an interesting development. And finally, just the one on the funds. Again, I think it comes back to that participation in Cat 2. It's part of that as well, which is, I think, depending on the scale of the firm, will be whether or not that is a smart move to have the funds or not. And so, for a large scale advice firm, we think, unitizing your solutions, there's a lot of efficiencies there, and you can drive some really good economics that push managers down in fees and that if you've got a big network and you've got a big multi-manager, right? But when you're a 5-person business, having your own unitized solutions is probably going to be more risk than benefit. But again, it depends. It's not a one size fits all.
Yeah, very interesting. Tell me, DFMs have been around longer in the UK. What's the trend that's there, and are they saturated, do you think, from a DFM perspective, even if it's just in the upper end of the advice
Hmm.
market? Or have they actually cracked that, the more sort of general practitioner market there? And do they
Hmm.
have a greater amount of conversion within their books?
Hmm. So very similar numbers. I think what is interesting because I work across the two markets is I'd say sometimes the UK leads on a trend, but then sometimes South Africa overtakes, they see the trend and then everyone pays attention and it grows. So DFM acts kind of like that, where actually I think we're at the point now where it's a couple percent higher penetration in South Africa, but it started later. So we saw this trend playing out very rapidly, but there are some differences. So when I mentioned DFM and MPS, I'll oversimplify. There's even a higher end of DFM, which is bespoke, like Quilter Cheviot and that in the UK, which is actually a bit more like, I think Melville Douglas would be equivalent here. So it's the real full discretionary, securities and unitized vehicles, all that mix. Then you got the DFM here, and then you got MPS. And I think what is interesting is in the UK, we are definitely seeing that MPS drop. And what it's doing is it's putting a lot of pressure on the value proposition of the DFMs, because we're saying, well, if this thing's really efficient and it's cost effective and all these things, then why are these more expensive? And I think what's interesting is in South Africa at the moment, DFMs are successfully driving partnership. And I mean, look, it's in the data. I show you the number one reason for why an advisor works with a DFM, when we ask them, they say it's the partnership, it's the relationship with them, etc. They've helped me evolve my business. But what's interesting in the UK is we've started to see some of the more hands-on DFMs lose that. invest less in that and kind of become asset managers. But then they're kind of feeling the effects of that because now all of a sudden, if they're not helping the advisors and investing in them and helping them evolve their business and that, then all of a sudden there's more price pressure, more questions around performance, all these kind of things. So that's probably the difference. But I'd say MPS has played out more so in the UK. That's why we think it's going to be an interesting trend here.
Ah, yeah. Watch this space. And tell me, what stops an advisor converting more of his book? Is it the CGT discussions? Is it just I'm running out of steam? This was a great idea a couple of years ago, and now I just or is it I've just got a tale of clients who I know aren't gonna buy the
Mhm.
DFM. So, what stops that kind of last 40-50% of an advisor's book going into a DFM?
Well, I guess I mean, I'll start with what stops the flows sometimes as well, because sometimes
Mm.
they'll sign up a DFM and they're not even getting all the flows. That to us is generally when no one's done the work to connect the advice process, the customer segmentation into the DFM answers, right? And so whose job is that? Well, look, the DFM benefits out of getting involved. So you'd think there's a kind of a meeting of the mindset. So sometimes we see a DFM's appointed and the flow isn't nearly as high as they thought it would be, but it's because no one's ever linked these things, right? Advice process into the solutions. But in terms of the assets, so assuming the flow is going well, in terms of the assets, sometimes it's the same with platforms, is sometimes I'll say, look, it's not ideally where I would have the assets, but there's just too much effort, right? It could be CGT. There's a range of potential reasons behind it, but I think it's really just this bit around effort and the value that we're going to get out of it. And that seems to be the main issue. And the challenge is the current market context is last 12 months, 17% asset growth, but like 2 and a bit percent net flows of the 70. So in other words, that bit that is not on DFM it's gonna keep growing really fast. So what that means is flows aren't really changing the mix quite as quickly when asset growth is 17%.
Yeah, I get you. Okay, cool. Earlier on, Evan, we touched on advisor consolidation. I'd like to delve into that a little bit more.
Hmm.
You mentioned that one of the big reasons that advisors are looking to move is because of regulations. Can we unpack that a bit more? And where are people going? What's the kind of spectrum of places they're going to kind of, I guess, if you like, find safety from the regulation piece or the other stuff that's perhaps keeping them up at night?
Okay, great. So I'll start first on the regulation point. Something I actually wanted to mention earlier, but didn't get around to. And I'll get there's kind of maybe two soapbox moments here. But I guess the first on the regulation side is it is interesting. I do think regulators can choose one of two angles. They choose professionalization and value for money, or they choose access to advice. And I'll give you a clear example. Let's say we doubled life insurance commission today. Value for money would get worse, but more people would have life insurance policies because it's twice as much commission, right? And the UK went value for money and professionalization with less access. Australia went same way. South Africa is going the same way. So, but we have a pretty big market with a pretty significant advice gap, especially in mass affluent and that. So anyway, it is strange, but our market direction does seem to be one of we're going to make it harder to do business and fewer people will have access, but it's going to be, better value for money, stuff like that, right? But anyway, with that as the landscape and the context, we're finding advisors are saying, I'm going to be able to deal with fewer clients and my costs are going to go up. So costs of doing business go up, the time cost goes up, therefore the number of clients I can serve goes down, which means the revenue goes down. So, and this is why early on, when I talk about the advice fees, some advisors in South Africa say, I don't need to charge more. I run a good proposition. I don't want to rip my clients off. Fine. Yeah, but it's going to be hard to reinvest, especially when there comes this margin pressure. So sometimes charging good enough advice fees around having the room to maneuver. But anyway, so back to the point. So we're finding some advisors saying, I can see there's going to be a strain on the equation. Costs go up, number of clients I can serve go down. And fundamentally, most advisors we talk to want to be in front of clients giving advice. And they're saying, I'm seeing more and more of my time is spent on the computer and doing compliance forms and this and that. So that's a big driver. We see so where they're saying, look, if I join a firm where someone's going to take care of it, there's that. But the other really big one is succession plan. And we talked earlier about the matchmaking and someone similar to them. Interestingly, what I'm hearing a lot of is advisors say, let's say they're in their 50s, very successful. They want a 30-year-old advisor. They're saying, I want a 30-year-old I can bring in and this and that, but they don't know where to find them, right? Especially if they're a one-person business or a five-person business that's all in a similar age. So those are the two main things that we see are driving it. And so I'm just coming back to Chris, I can ramble on a bit, but
Oh,
where are
it's
they
great.
going? So in the UK, they say, I want to join a firm. I want to partner with an advisor just like me. That's not what they're doing in the UK. They're joining larger scale firms because in reality, the capital's there. And there's always this trade-off around like the valuation and the culture and what they're looking for. In South Africa, when we ask advisors what's important, culture's first, and valuation is depends, second or third. The older the advisor is, the more the valuation piece pops up because we can't get away from the fact that most of the time advisors spent this whole time advising clients on their retirement plan, but the advisor's retirement plan is to sell this thing for a multiple now, something like that, right? So if you're getting offered 2, 3 times everything there, but I guess we're starting to see some dodgy. And again, so you mentioned it wasn't INN8, the platform earlier. It's also not anywhere within Standard Bank Group that we're seeing this dodgy stuff, but we're starting to see dodgy behavior here where we're seeing these multiples that go, well, at that multiple, something is bad. Something bad is happening, right? And we're starting to see a little bit of that. It's the same thing that led to the Royal Commission in Australia. It's the same thing that led to the FCA intervening in the UK. The good news is, to answer your question where people are going, we're seeing more people choose culture over the highest possible number. And at the moment, that's still promising to see. But yeah, there's always going to be that kind of trade-off. And there's no magic trick. If the number's really high, your clients are being ripped off, right? So anyway.
Okay, so that's quite. So what is the kind of the average multiple? Are you able to talk us through what that
Sure.
looks like?
Sure. And look, a lot of the firms that are in the space will then get annoyed at me because they'll say it's way more, nuanced than a gross revenue multiple. And that, but generally what I find is if you go through all their very complicated calculations and discounted cash flows and all this, you do end up with a pretty consistent range of revenue multiples for most of these businesses. So, all right, I would say in South Africa, firstly, there's something around if they have a set of solutions and everything internal, it'll generally be a little bit higher. Most do, right? There's very few that don't have some form of solution. Generally would be somewhere like 1.5 to 2 times gross revenue. You could call it maybe just under 1% to 1% of assets, right? 1.5 to 2 times gross revenue is pretty standard. Up to 3 times is where we're seeing acquisitions at the moment in South Africa, and those are quite attractive. When we start seeing 4 and higher is where we would set off like alarm bells. So it happens, but we saw numbers as high as 15 times or 16 times in the UK. But you can bet those are the ones being investigated by the FCA now, right? So generally, to go back to your question, 1.5 to 2 feels about right. Maybe it depends on the context. And we see acquisitions taking place, that kind of 3 number as well. But again, there's a lot of context and analysis that goes into that. It is about 1 times lower than the UK. So UK, instead of that 2 to 3 range, it was 3 to 4 range. But again, that's coming down. Some of the firms in the UK, what's interesting is they knew the market price was that. So they started paying that, but they never figured out how they were going to make money on it. So then now the whole thing's imploding, right? So there's also that thing is not everyone's done the maths on how it's going to work.
And what can an advisor do to maximize the
Mm.
value of their business? And I think that's why we're seeing so many kind of distractions into the value chain, distractions elsewhere. Like, are they doing the right things to maximize the value of their business, or are they doing the wrong things? And what are those right things to do?
So I think the simplest one, look, we haven't done a ton of work in the space, but I'll give you what does kind of come to mind immediately. And having spoken to some of the businesses and it does link to that piece earlier around the extent to which you've institutionalized your operation. And I don't mean that like, in a bad way, but I mean in terms of you've got all these ideas but to what extent does it play out into a nice, clean business model that's scalable and all that? So one of them will say, look, if you've got 200 clients and each of them has a different set of funds they're invested in, and you as the advisors picked a bunch and combined it, that's not worth quite as much because they look at that and say, this is going to be a risk, a hassle to deal with, et cetera, et cetera. So for starters, this piece we talked about with DFMs earlier, but it doesn't have to be DFMs. It's just centralized investment proposition. We have a good understanding of our clients. First, we've seen them all on a recent basis because I know it's supposed to, but every now and then we speak to an advisor who says it's been a few years since I've talked to these clients, especially when markets are tough. So that's not great. But you know your clients, you've engaged with them, you've segmented them, and you have a house view for each of them. That seems to be a really big part of it. Now, the rest, of course, there's bits around how old the book is, because accumulation assets versus decumulation assets. There's all of that, but that's not so much within your control. I think the main one immediately in most advisors' control is your ability to articulate your business, your value proposition, your segmentation of customers, and having them in clean solutions and centralized investment propositions, house views, whether it's with DFM or not. I'd say it seems to be one of the biggest ones.
That's interesting, Evan. Thank you. Um, I'm going to move into something else. We've had quite a few questions come in. Great to see some good friends on there. Jeff is on there. Eleanor, Nick, thanks so much for asking questions. A couple of questions coming in about AI and how AI is coming into the advisor space. Um, and again, it comes back, I suppose, to this core versus distraction. I think we hear a lot about AI. But do we really know how to use it? Is it just something we talk about, or is it actually being actively developed and used in the advisor space? What have
Hmm.
you picked up around the AI space?
So, well, I guess starting question, we talk about the age groups and that advisors are, on average, particularly younger or older cohort, right? If we're thinking about probably a bit older, right? On average age, we always talk. An AI adoption is faster in the advice landscape than anyone else we deal with. We're always so it's funny because you sometimes think that tech starts with the younger ones or the ones that are going to embrace it. But what I've observed in all our discussions is that advisors of any age are adopting AI or trying it out faster than anyone else we deal with. And I think that it's interesting. Well, they've led us in some cases. Because so, for example, Fireflies, in so many of our advisor interviews, they've got transcription. And we go, well, we're interviewing people the same way advisors interview their clients. Why aren't we using transcription? So in some ways, they're led. 2 years ago, AI was theoretical when we spoke to advisors. It was, I can see the opportunity, I can see a threat. And I actually do see a question that came in just around the threat, and maybe we'll get to touch on that. But last year, we asked, how are you using it currently, and how would you potentially like to use it in future? And so at the moment, what we're observing is, and actually South African advisors, again, using it faster than UK. So in the UK, half of our interviews are still phone calls. In South Africa, they're all some form of this, right? Teams and Zoom and that, right? And so faster in South Africa. The main use at the moment is communications, whether it's email polish, whether it's weekly kind of newsletters, something like that. We also do have it for digesting information. I think either a really long thought leadership article or a colleague who writes long emails and you need to get to the point. So something around like lots of info
We've
comes
got a
in. I
few of
need the
those.
point.
Yeah.
Yeah. And so it seems to be around that. But where I'm excited and where advisors are excited is where they're saying in future, it's going to be operational efficiency. And that's the goal, right? Because if we talk about core and distraction, they're saying there's a bunch of things that we think are potentially distractions. Not to say it's not important. It's like, for example, compliance. Very important to be compliant. But could we get some help here? Or could we get help? And basically, it's like AI in future might be this intern that won't quit. Doesn't matter how much boring work you give them, they'll just do it. So I think that's the one. Um, sorry, do you mind if I see the question around the
Yeah,
threat.
no, I was actually, yes, I was going to direct you there anyway. The question essentially is how do we safeguard ourselves? How do we make sure we keep the integrity of the client data, and what are the risks around AI? So perhaps you could touch on that, Evan. Thank you.
Okay, yeah. Okay. Oh, sorry. So on that one, I've got to be honest. I'm not close enough to detail to know. And I would like to think. I mean, so similarly within NMG, you'll take a company policy around this is use the ring-fenced environment. There's things like that. So I think the exact risks around the operational risks are ones that there'll be experts, there'll be people that are kind of solving that, and this is the kind of right way and wrong way to do it, especially when you're dealing with client information, obviously, right? So there's that bit. I think the risk bit and kind of I was looking at the risk, and we've heard it before around replacement of advisor or competition with advisor. And I think to me, it's just an extension of what we've been saying for 10 years. People have been saying, does Robo replace advisor? And now it's like, okay, well, AI has now put Robo on steroids. And so, but even then, I think it's a continuation of the same thing, which is if your value prop is that I'm going to risk profile you and put you in a solution, and if that's the entire value prop, then Robo was a threat, and AI and Robo is a threat. But if your value prop is client interaction and understanding the needs and engaging them, and this is when you ask clients the value of advice, it's all about that. It's not about, oh, they really understand, Japanese micro cap and they're talking to me about like, no. If you're saying you're sitting down with them, COVID hits, I don't know what's happening, but we got people on, I'll keep you posted. This is what we're doing. Stick to the long-term plan, bring them out of the weeds into the picture. I think the personal elements are not at risk of this if done right. But yeah, I think that's just an interesting one is that it's going to really force some people to evolve the value prop. And it's robo on steroids there now with AI.
And you know, the World Economic Forum and various
Mm.
other organizations have said, you know, actually financial advice is not vulnerable to AI in the same
Mm.
way that lawyers and accountants and people like that are, because of this relationship that they hold. And I think what you're seeing, and certainly what I'm seeing, is AI being used in a systematizing way. So how do I systematize those boring, mundane tasks, which is exactly
Yeah.
how you see it as well. So you know, it'll be interesting to see how it develops going forward. And as you rightly say, there's risks, but there's always risks. It's about how
Mm.
you mitigate them as you go forward. Okay, so is there anything else you want to add on
Mm.
AI, Evan?
Yeah, sorry, the quick one I was just going to add was I think we've got people joining from, various different models out there, but I do think an interesting one is we are definitely seeing it as an incubator. So I'm not going to pretend people aren't getting advice from AI. I know
Yeah,
that, I spoke to business who said all of our inbounds right now are coming from ChatGPT and that. So, but those aren't your target clients, right? But I think what's interesting is there's an incubator phase, and then there's when I need proper advice around something quite complex, and I want to talk to someone, and I want, X, Y, Z. And I think, I'm not going to butcher it by putting numbers up there, but there was another DFM who presented, here's the fun performance, but here's the loss in performance because people entered and exited on emotions and at the wrong time. So is AI going to stop you from making bad decisions and what, kind of thing. So there's a lot of the elements beyond it, but I do think what is interesting is it will be an incubator. And especially if you think like a banking environment, right? There's a lot of opportunities to see how it might incubate people, bring them into the system. But I think the high-end advice, and I'll use a personal example, is I have a relatively complicated situation traveling back and forth. The advisor I went and spoke to, firstly, they charged me a couple of £1,000 to sit down and have a conversation, right? But I'm not benchmarking them. I'm not trying to get AI to do it. If this is complex and someone can answer this question, right, then I'm not picking the fees in that out. You're kind of willing to pay for value if you have a situation where you do want it, right? And I think that that's a key bit, but we're going to see commoditization. The floor is going to rise, right? And if you're operating below this and the floor comes to here, then it's not a good spot to be, right? But we think more opportunity than risk.
absolutely. I mean, my experience, and tell me if you experience the same, is, you know, advisors always say to me, you know, my client book is somewhere in the age range of 45 to 85, say. You know, that tends to be my client range. And there's a reason for that, because, you know, people before that age are relatively happy investing themselves. And then a life event happens, either a divorce, a
Mm.
death, something happens that's big, and then the loss aversion hits in. Now,
Yeah.
everything that I've actually built up myself, I'm actually worried I'm going to lose. And that's when they seek advice. And so I don't see that client age range changing. And I don't know whether you agree. But I guess the question is, how do you access those guys who are happy to use, you know, more kind of technical self-invest tools, but then
Mm.
know where to access when they hit that life event
Yeah.
that really does require advice. And I think a lot of people realize they need advice at such a life
Yeah.
event.
Yeah. And so I think an example, it's not the only, there's a lot of them, but an example is you might have parents and child, and then you got child's very happy to invest crypto, Bitcoin here, pick stocks, whatever, Robin Hoods and whatever it is around the world, right? And very happy. They pass away, inheritance. They're not going to put the inheritance on Bitcoin, right? So unfortunately, they do seem to buy houses, especially in the UK with it. So it does potentially exit advice. But I think there's this key point is that there's messing around when you're starting to accumulate a little bit of money. And then this is now a big deal and I must not mess this up, right? And so I think we do see these triggers for advice. And so I guess, George, how do you make sure you're there when that happens? And I think what's interesting, even prior to AI, we did see in the UK, saw less in South Africa, but I think the D2C world is not quite as far in South Africa as it is in the UK. But advisors who say, I'll bring the family in and I'll tell the children, play around on your D2C thing, and we'll chat about it, but I'm mainly dealing with the parents, money here and all of this. But maybe what they were doing was they were saying, let's start to put a little bit aside like this under my advice here, but then we'll keep your portfolio. So almost like don't fight it, but especially if it's within the family, I think we get really excited when we talk to advisors where they challenge us. We say, how many clients do you have? And they say, well, we don't count clients. We have 90 families, right? And that's quite exciting because they're starting to think about that. And it doesn't mean forcing the kids to invest in what they might consider as a boring but relatively reliable strategy. Sometimes it's let them do their thing, but be ready for the fact that there's going to be triggers where there's a chance to give advice and kind of get involved.
Yeah, much more of a kind of American view as well. Looking after families. There's, my maximum is 40 families. That's what I can manage. Neo, I hope that answers your question about the relevance of financial advisors going forward. I certainly believe, and I think Evan does too, the relevance of financial advisors is absolutely here to stay, mainly built on relationships and trust, and really driven by life events that people need advice around. So I hope that answers your question there, Neo. I want to move on. I want to move back to the comparisons between the UK and here, and I want to really think about how advice firms, what I've seen in the UK is advice firms sort of again trying to go down the value chain, but trying to get involved in platforms, trying to get involved in white labeling,
Mm.
various integrations, and so staying with the tech theme, but what are we seeing here around that, and is it something that's going to grow? You kind of see like these micro techs pop up over there, and
Yeah.
so I'm interested as to what that's playing out as here.
Okay. Yeah. So I think first piece is being frank in the value chain. The least attractive part of it and is being a platform. And sorry, George, right? But it's
Welcome to my
just
world.
yeah, right. So it's the lowest margin part of it, and still people are pressuring the fees, right? So overall, we'd say it is not the most attractive thing to be a platform. It's a lot more attractive to be able to blame a platform when something goes wrong, right? And so if you think about it, say, well, as an advice firm, like, do you want to be a platform? And so I guess I'm get to it in a second is what's the objective, right? And so what are we trying to get out of this integration or doing something with platforms? The other one is there's an abundance, the same thing in life insurance, is we get an abundance if someone comes to us and says we can run a platform at like 5 bips, but those guys always go missing a year or two later because there's a lot to it, right? So it's never as simple as tech can just do this thing and that. So it is a very difficult part of the change to be part of. It looks always easier than I think it is in practice. So if you're a large scale advice firm, why, right? So we're thinking why, and I think there is a reason why. The reason why is if you can streamline the journey. If you can streamline, and there's a large scale advice firm in South Africa that's relatively good at it, and people know, but I think there's some that are really good at this thing where you come in, we go through this advice process, and you don't feel the platform. You go through the advice process, you end up in the solutions, and this thing is done well, and the reporting's done, etc. And I think that's a compelling value proposition. And so when you're a large scale advice network, you might say we either want our own platform or we want a white label, which is what we've seen a little bit more of in the UK. So some large advice firms in South Africa built their own platform. If they had at the time platforms willing to white label for them, would it have been logical for them to maybe just do that instead? Probably. But I think so having an integrated offering, and sometimes in the UK, we're starting to see is a little bit more of don't make me come to your world, meet me in my world. So I've got my advice process, this is a network or something, and I want to operate here, but then execute through a platform. So that's an interesting development. But I think that for the average advisor or someone who's not trying to build this for their own network, it's increasingly more a case of just integration into the back office systems that they use. And I know, George, we talked about this a lot, and there's a lot of developments, potentially taking place in the next number of years across markets. But in the UK, we are seeing more of that. So the majority of advisors we talk to have some level of integration between the equivalents of Elite Wealth, at Work, Xplan, and the platform that they use. And so I actually like if we talk about like the white labeling or the modularization of platforms and that makes more sense to me, where an advisor is going to say, this is with the sole purpose of making this slicker, more streamlined, operationally efficient, less double checking and repetition of tasks in that. Being a platform, I don't think it's a compelling value prop for the average advisor.
So, do you think there's going to be more and more sort of micro technology as well? So beyond the X plan, beyond the elite, so things that will integrate in but do certain very specific jobs. I mean, one of the things we've got integrated into our platform, of course, is the Morningstar research tools, but something,
Mm.
around that kind of technology. What do you think there?
Yeah, so I think we definitely, and we're starting to see it, and sometimes it's being built by the advisors, right? So it is interesting that sometimes I won't call names, but sometimes some of the largest
Yeah,
providers are doing less innovation, and then an advisor goes and builds something very impressive. And so, but I think the key point that you mentioned was integration, is that
yeah,
we get nervous when an advisor goes and builds a bunch of things that don't integrate. So say you've only made things less operationally efficient, but I do think we'll start to see that, right? Modular, specialized things pop up, but they need to integrate, and because otherwise all it does is takes us backwards, not forwards, in terms of efficiencies.
Yeah. Yeah, I agree. So a few years ago, Evan, we spoke about the differences in the value chain
Hmm.
in the South African market. We compared it to the UK market, as you rightly said earlier. Advisors here charge less than their peers around the world, and there's opportunity to move. And you predicted that there would be a squish in the asset manager and a growth in the advisor fees. Have we seen that? And if not, why not?
So seen a bit of squish in asset manager fees. There's a little bit where there's some take up of passive, definitely, and there's a lot of intentions to still grow it. So I mean, the quickest squish is if someone allocates more to passive just because of the delta in fees, right? So there's that. I think we have seen a squish. There are large balance funds in South Africa that charge quite a lot of money for a brand premium. And so we've seen less usage of that. So, if especially when someone works with a DFM, one of the first things will be a little bit of a recalibration of the portfolios, and we'll use maybe some of the blocks and that anyway. And so generally, I think the DFM take up has been part of the reason that we have seen some pressure on the fees there. But interestingly, it hasn't compressed quite as quickly, and the advice fee hasn't gone up quite as quickly. Maybe it's just a case that things happen slower than we thought. So I still believe in the end state, which is I still think advice fees are going to go up by about another 10 bips, and I think the rest of the chain is going to compress, I think, all in by about 20 bips. So we're going to see that kind of somewhere around there. I think the chain's going to come down by 15 to 20, and advisors component come up by 10. But I think, look, platforms continue, right? So continuously we are seeing that. I think one of the reasons that we haven't seen the DFM fee come down is because a lot of the advisors with the power to negotiate fees are taking half of it, right? And so that's when we talked about earlier, the core and distraction, or kind of core and non-core, is that those advisors could have squeezed the DFM and then taken more in advice fee, and then it would have made the trend play out further. But instead, at the moment, we're seeing some of them say, well, actually, I can get 10 bips here from Cat 2. And then what that does is it holds that trend in the same place, right? But yeah, I think that's an example. But I do still think we're going to see it. And it's just, I guess, a matter of time.
And overall, what do you think the overall price of a
Yeah.
solution for a client is going to end up at? Where are we now? Where do you think it's going to end up?
Yeah, so talking ex-VAT, AMC only on the asset management. I've got to get the caveats out the way. So there's no performance fees or anything there. But if we're talking annual fee, advisors are anchoring to a 2% is a number I've heard a lot of. Now, depending on you, some advisors will already be below that, and they're built around a 160, or if you're pure passive, you get really low. So I'm not going to say that that's the right number, but there's a friction point. It's a nice round number. And the averages we're seeing are normally 2.1, 2.2%. That's why I'm saying this kind of 20 bip drop. And it depends on the size of the advisor's book. It could be quite a lot higher as well. But we are hearing a lot of narrative around this 2% objective. And the 2% objective, as articulated by a few advisors to me, and there's similar numbers, is 70 for me, 30 for platform, 20 for DFM, 80 for asset management, or 30 for DFM, 70 for asset management. Basically, DFM and asset management play in the same pool, right? Squeeze them if you want more yourself, kind of thing.
Okay, that's interesting. And talk to me a little bit about the passive
Hmm.
market and how that's come into South Africa. It was a little bit of a long time coming to South Africa. Obviously, South Africa is a smaller market. They wanted to make sure they got value here. What are we seeing play out from a passive perspective versus the active management perspective?
So this is a market that does like active more than other markets like active. So we are always, I think, going to have a little bit more active than some of the other markets, right? There is this kind of view, and there's view as well, that there's lazy money in South Africa, people globally investing but not caring to outperform, which makes it. So there's theory around, that, right? But with that out the way, we are seeing growth in passive and growth in intentions in passive, and every trend is then correlated to it. So what I mean by that is, we asked advisors in August or so last year, how are young clients different? And one of the ones that came up was more interest in passive. So the younger clients more likely drive passive, as well as very speculative other stuff on side, but passive. Younger advisors we interview are more likely to have higher passive allocations already and targeting higher passive allocations. Offshore, which I'm sure something we'll touch on at some point, but the offshore investments advisor telling us that's where I'll use passive more as well. And so all these things are growing. The number of young clients, obviously, the younger advisors, offshore investments, DFMs have slightly higher passive allocations typically. So in other words, even if it's not an explicit, I'm going to put more in passive, the way the market's moving is correlated to more passive being used anyway. But yeah, fees are still a little bit higher in South Africa, just given the scale of the market, right? You can't drive these things down to a 5-6 bit like you can in some of these other regions. But yeah, they'll be more passive, but I think it is a little bit more offshore, and we've always still got this kind of active, belief still for a big part of the portfolio for a lot of advisors.
No, absolutely. And you've touched on offshore there. Let's dip into offshore a bit more. What is happening in the offshore space? Of course, we've seen fantastic local performance play out, and now, of course, we've got a very strong rand. What's happened to the investment in offshore, and what's the sentiment towards offshore compared with what you've seen in the past?
Yeah, so 3 years ago, somewhere around there was very bullish offshore. So we had advisors saying, I want to kind of triple my allocations from, let's say, 20 to 60% of all assets. So we had very bullish numbers around offshore allocations. Obviously, it depends on the wrappers and the context in that, and the client base. But on average, tripling. And we run quarterly market stats and information on the industry. And what we saw was the majority of all net flows were hard currency offshore. So it was happening. So call that 2 years ago. Majority of all net flows offshore, and people were telling us, I want to triple this allocation. And in the last year, what we have seen is positive narrative around South Africa. I think, comments like, I think local equities might be undervalued. There's a good opportunity here. Politically, fingers crossed, it seems more stable than whatever's going on over there. So we get a little bit positive sentiment. And what we've seen is a drop. But I think what's wrong is to think, oh yeah, offshore's over, because they're still telling us I want to double it. They're just not saying I want to triple it. And so now when we talk to advisors, they'll say I'm at 23 and I'm targeting like 45 or something like that, right? So it's still a very big growth. It is still a clear focus area. It's just not offshore as the silver bullet that solves everything. It's now, there's definitely something to do here, but we're also at the same time seeing opportunities in the local market. So I think it is just interesting from that kind of angle. And you mentioned the currency one. So it was, lose track of time now, but whenever there was a whole impeachment in Brazil and the real plummeted, and then everyone says, let's go shopping and bring our money offshore when it's worth nothing. And so the challenge is you often see currency goes down and then everyone says, let's get out. And then they're shopping with nothing. They buy high and sell low or whatever, so right now, if South Africa, if the rand's particularly strong, this kind of is an ideal time if you're going to target certain allocations. It is kind of an ideal time to do that, rather than have some political challenges and rands dropped, and the next thing then we go shopping, right? So there is always that disconnect. Whereas when the narrative is strong around let's bring our money offshore, is probably when the rand is weaker. Hence, yeah. But yeah, still set to double.
It's why people need advisors, right? That's for sure.
Yeah.
So tell me, Evan, can you summarize for me what you think has happened in the last few years here in South Africa, and what you think will happen in the future? Can you sort of, just tie it all together for me, if you wouldn't mind?
Yeah, sure. So last few years, I think it's been relatively consistent, but I think the last few years has been a little bit the professionalization of the practice, it's happened at different rates. 5-10 years ago, there'd be some advisors that are already ahead of with the averages today, right? So it's not going to be all, but I would say that we sometimes talk about the phases in market between salesperson, holistic advisor, holistic planner, business owner. And it's kind of like at the start, the product leads everything, and you're going to find a way to make that product relevant to those clients. And continental Europe is still largely there. South Africa is largely not there. And we have seen this transition into focus on holistic advice, professionalization of the offering and that. And we've started to also see a shift into some of the business owner mentality around things like my succession plan and how slick is my operation, and can I articulate it, and do I have a repeatable advice process and segmentation and centralized investment propositions. So I think we've clearly seen this holistic advice folks. Even 5 years ago, I think most people were not sales, but they were that focus on planning and proper advice. But we've seen that kind of professionalization a bit in the last 5 years. And I think that's where appointing DFMs, and look, I'm not being paid by DFMs to say this, right? I'm not being paid by anyone to do the session. So But DFMs are part of this thing around, well, I'm going to appoint a specialist here that can maybe do it better than me, but definitely save me a lot of energy, right? And there's other areas where they'll appoint specialists. And I think that's the start of this kind of business owner mentality around where will I partner? What will I do? What will I use others for? And how do I make it more efficient? And so I think that's what we've seen. I think we're going to see more of that, in the next couple of years as well. But I think people are starting to also look a little bit like further out now when you start talking things like succession plans and joining larger firms and that kind of thing.
Absolutely. As we've meandered through our conversation, Evan, we've pretty much
Mm,
hit off most of the questions, but there is one still outstanding from Eleanor. Eleanor, thank you very much.
mm,
Jeff, I think we agree with everything you've said on here, Jeff. So thank you very much. Absolutely, professionalizing your platform is important. Going back to Eleanor, regarding advisors being concerned about regulation and considering consolidation or selling, are these firms perhaps not proactively adapting the regulation that's potentially coming our way? In
mm,
draft papers, etc. Or, are we aiming for compliance to the letter of the law, or is it much more about the spirit of the law?
mm.
What are you seeing?
Yeah. So interestingly, every now and then in prior years, we'll have a client who gives us very specific regulatory pieces to ask advisors about. And what we've realized is 99% were saying, well, I'm not familiar with the details. I don't think it's being driven by the details. I think it's being driven more so by the concept of regulation and compliance and the concept that what we've seen in other markets. And look, in their defense, these things move, right? So in South Korea, and sometimes you're trying to find the details. You have to click this link and that link and try and dig really to find something. So I'm not kind of saying that negatively for advice, but I guess what I'm saying is it's not necessarily that we know exactly what's going to happen and how it's going to play out. And so it is a little bit harder for some advice. So maybe it's the uncertainty that drives some of it, which is saying it could go in a few different ways. But also, I think if it goes anything like what we've seen with the FCA in the UK and what we've seen in Australia, is you can basically count on extra costs, extra work, harder to deal with any given client if you're a one-person business, right? So you can generally count on this, and this does put pressure on the kind of economics. So I think some of that is driving people. Instead, they can see the writing on the wall. They don't know exactly how it's going to land, but they can see that in some shape or form, it's going to make my life a little bit harder. But yeah, I think maybe the uncertainty of what exactly will land is, if anything, kind of speeding up that kind of shift.
Yeah, absolutely. Evan, thank you very much. Really, really appreciate your time this morning. Just for everyone that's listening, the two links in the chat are to follow my record-breaking swim, which plug again starts this evening in raising money for the Players Fund, Chris Berger, Petra Jackson Players Fund, 72 kilometers from Fishhook to Hout Bay. Please do support me and 3 other swimmers who are doing this swim. Thank you very much. Thank you so much for everyone for your comments. There will be a recording. You will get notified about CPDs. So please do stay tuned. We'll certainly let you know about all of that. Evan, thank you. A really, really fruitful and rich conversation.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.